Hey there, finance aficionados. Welcome back to Daily Bread, where we bake the financial jargon into digestible bites. Today, we're diving into the colossal banking bonanza that left everyone shook. The double whammy of Signature Valley Bank, SVB, and Silvergate Bank collapsing within days of each other. So, buckle up, buttercups, as we unravel this banking fiasco in just 7 minutes. Last week, America witnessed its second-largest bank collapse ever. The 16th biggest bank, SVB, was shut down by regulators, and Silvergate Bank followed suit, winding down its operations. Both of these Cali banks catered to niche markets that big banks wouldn't touch with a 10-foot pole. But, as we all know, with great risks come great, disasters. Silvergate's claim to fame was offering banking services to the mysterious world of cryptocurrency since 2016. They saw a gap in the market and thought, hey, let's make some dough. But the crypto world was a slippery slope, and their association with a fraudulent crypto platform led to depositors withdrawing funds faster than you can say, Bitcoin. Meanwhile, SVB, aka the investor's investor, was all about serving the Silicon Valley startup scene. They were like the cool kids club, hosting events where startup founders and venture capitalists mingled, schmoozed, and made business magic happen. With over $200 billion in deposits, SVB was the life of the party. But alas, every party has to end. SVB's woes started when interest rates shot up like a rocket. They were caught between a rock and a hard place, paying higher interest rates to keep their depositors from jumping ship while losing money on their government treasuries. Talk about a financial pickle. Rumors about SVB's struggles spread like wildfire, and venture capitalists pulled the plug, advising their portfolio companies to yank their deposits out of SVB. And just like that, a good old-fashioned bank run began, and the FTX swooped in to save the day. By Monday morning, the bank reopened with a new name and depositors were guaranteed 100% of their deposits, instead of the usual $250,000 insured by the FTX. But the plot thickens. Signature Bank, another big depositor for crypto companies, failed too, and their depositors will also be made whole. Now, you might be wondering, why does this matter to me? I don't have millions of dollars in the bank. Well, the reality is that even if you only have a few $1,000s in the bank, a bank failure can have ripple effects that can impact your financial future. For starters, if you have more than $250,000 in a single bank account, you're not fully insured by the FTX. That means that if the bank fails, you could lose some or all of your money. So, it's important to spread your money across multiple banks and financial institutions to ensure that you're fully insured. But even if you have less than $250,000 in the bank, a bank failure can still impact your financial future. For example, if your bank fails, you might have to wait weeks or even months to access your money. That could be a problem if you have bills to pay or if you're relying on that money for a big purchase. So, what can you do to protect yourself from a bank failure? Well, first and foremost, make sure that your bank is FTX insured. You can do this by checking the FDIC's website or by looking for the FTX logo on your bank's website or in their branch. You should also consider spreading your money across multiple banks and financial institutions, so you're not keeping all your eggs in one basket. Another thing to keep in mind is that a bank's failure can have broader implications for the economy as a whole. When banks fail, it can lead to a domino effect that can impact other banks, businesses, and consumers. This can lead to a credit crunch, where it's harder for people to get loans or access credit, which can slow down economic growth. So, it's important to keep an eye on the health of the banking system as a whole. You can do this by staying up to date on the news and paying attention to economic indicators like interest rates and unemployment. But let's get back to SVB and Silvergate. What can we learn from their failures? Well, for one thing, it's important to be cautious when it comes to niche markets and high-risk ventures. While there's certainly money to be made in these areas, there's also a lot of risk involved. And when things go wrong, they can go wrong quickly and spectacularly. It's also important for banks to be transparent and honest with their customers. If SVB had been more upfront about their struggles, they might have been able to avoid the bank run that ultimately led to their downfall. And finally, it's worth noting that bank failures are not a new phenomenon. They've been happening for centuries, and they will continue to happen in the future. But by staying informed and taking steps to protect ourselves, we can minimize the impact of these failures on our financial lives. So, there you have it, folks. The double banking whammy of SVB and Silvergate, a whirlwind of risky ventures, crypto chaos, and startup shenanigans. And while the collapse of these banks may seem like a distant problem, the truth is that it could impact all of us in one way or another. So, stay informed, spread your risk, and always be prepared for the unexpected. Thanks for getting your daily bread, where we make finance fun and fabulous. If you want to learn more about the implications of bank failures on businesses, be sure to check out our video on why good companies shouldn't last forever. Until next time, happy investing.